Welcome, investor, to today's market insights. History was made last week when gold prices briefly touched 1 lakh per 10 grams on MCX before retreating slightly. Many traders believe gold has peaked and the rally is over, citing the Veblen Effect, where demand rises only because a commodity becomes expensive and exclusive. But is this really the top for gold? I beg to differ. Let's dive deep into why the long term bullish trend for gold might just be getting started. While some believe the rally is purely psychological, driven by luxury buying and elite status appeal, I believe the fundamental case for gold remains unchanged. Yes, the easy gains might be behind us, but calling a long term top here is premature. The underlying drivers of gold's rise are still strong and multidimensional. Central banks, especially the US Federal Reserve, have followed a Pavlovian response for decades. Economic slowdowns, wars, or crashes, they slash interest rates, print unbacked paper money, and bail out failing institutions. Post COVID, 1 out of every 4 US dollars in circulation was printed. The result? Sticky global inflation. High inflation has historically been the perfect backdrop for a gold rally. With political pressure mounting on the Fed to cut rates again, gold stands to gain further. Economic theorists argue that printing unlimited fiat currency is manageable. Excess liquidity can be sucked out later, like sipping a milkshake. But history shows liquidity shocks often lead to sharp market crashes. When inflated assets fall, investors flee to safe havens like gold. This cycle keeps the demand for bullion alive. Europe and the US face looming pension law challenges. With pension funds being major drivers of stock market rallies, any slowdown in inflows means less support for equities. Outflows from stocks combined with piles of unbacked currency looking for safety are likely to find their way into gold investments. Automation driven job losses, AI disruptions, persistent inflation, and geopolitical tensions from wars to terror attack states are spurring safe haven buying. Eastern European and Asian central banks are already buying gold at record levels, further strengthening the long term outlook for bullion. History reminds us that in tough times, governments have often seized citizens' wealth, from the 2012 Cyprus banking crisis to Spain's bank shareholder haircuts to US restrictions on silver ownership after the 1929 crash. These precedents fuel panic buying in gold as investors try to protect their wealth from unforeseen government actions. With BRICS nations exploring a gold backed common currency, a painful monetary reset between East and West seems inevitable, making gold a key player in future trade. Meanwhile, illicit trade and terror financing, once facilitated by anonymous banking, has shifted to gold and cryptocurrencies, further increasing global demand for bullion. The journey for gold won't be smooth. Profit taking, speculative shorts, and temporary government interventions may cause volatility. But looking beyond 2025, the fundamental of gold to a sustained uptrend, a slumbering giant has awakened. The real party for gold investors may not even have started yet. So ignore the short term noise, stay patient, stay informed, and remember, gold's story is far from over.
If you enjoyed this video, don't forget to like, share, and subscribe. Your support means the world to us. Thanks for watching and have a fantastic day.